Michael bought a rental property. James bought shares of an index fund. 10 years later, one of them is collecting rent while he sleeps. The other has a portfolio worth hundreds of thousands of dollars. Ask either one who made the better decision, and they'll both tell you they won. But when you strip away the opinions, ignore the social media gurus, and force both investments to play by exactly the same rules, one strategy quietly pulls ahead. Then, years later, the other catches up in a way almost nobody expects. The surprising part isn't which one earns more money. It's when it earns more money, why it earns more money, and the hidden cost almost every comparison conveniently leaves out. So let's make this as fair as possible. Michael and James are both 30 years old. They both earn $65,000 a year. They both managed to save $50,000. Neither has any debt outside normal living expenses. Neither receives an inheritance. Neither gets lucky with a business. Same city, same salary, same starting line. The only thing that changes is what they decide to do with that $50,000. Michael uses it as a 20% down payment on a $250,000 rental property. Nothing fancy, just a clean 3-bedroom home in an average neighborhood with steady rental demand. He signs a 30-year mortgage at a 7% interest rate. After taxes and insurance, his monthly mortgage payment comes to roughly $1,700. Within a few weeks, he finds a tenant willing to pay $2,000 a month. On paper, that's about $300 in positive cash flow before accounting for repairs, vacancies, maintenance, or property management. Michael feels like he cracked the code. James takes the exact same $50,000 and invests every dollar into a broad market index fund. No leverage, no mortgage, no inspections, no tenants calling because the water heater stopped working. He also sets up an automatic investment of $320 every month. Then, he closes the app. His coworkers ask what he's investing in. Just an index fund. Most of them shrug. The conversation ends almost immediately. There's nothing exciting about it. No house, no keys, no photos, no one congratulates him. On day one, Michael owns a property worth $250,000. James owns a brokerage account and an email confirming his purchase. Emotionally, it doesn't even feel like a competition. One person looks like an investor. The other looks like someone who clicked a few buttons on his phone. But investing has never rewarded appearances. It rewards numbers. And over the next 20 years, those numbers begin telling a story that almost nobody sees coming. For the first few years, Michael is living what many people imagine financial freedom looks like. Every month, rent comes in, the mortgage gets paid, and little by little, someone else is helping pay off his house. He checks his banking app almost every week. Watching that rental income arrive never gets old. It feels like proof that his money is finally working for him. James, meanwhile, doesn't have much to look at. His index fund goes up, then down, then back up. Some months his account gains more than his paycheck. Other months it loses $5,000 before lunch. Nothing about it feels predictable. Nothing about it feels exciting. The only thing he does every month is buy more. Whether the market is rising or crashing, his automatic contribution goes through anyway. No headlines, no celebrations, no stories to tell. Then reality starts knocking on Michael's front door. Literally, one Saturday morning, his tenant calls. The water heater stopped working. Replacing it costs $1,800. Just like that, 6 months of cash flow disappears. He tells himself that's just part of owning real estate. A few months later, the tenant moves out. Now the property sits empty for 6 weeks. No rent, but the mortgage doesn't care. Property taxes don't stop. Insurance doesn't pause. Utilities still need to be paid. Every month that house stays vacant. Money flows in only one direction. Out of Michael's pocket. Eventually, he finds another tenant. Things settle down. Then the air conditioning fails. Another few $1,000s. Then the roof starts showing signs of age. It's not an emergency yet, but he knows it's coming. Owning real estate isn't just buying a house. It's buying every future problem that house will ever have. Meanwhile, James barely notices what's happening. The stock market has bad months too. sometimes terrible ones. During one correction, his portfolio falls nearly 20%. Friends tell him he should sell before things get worse. The news says a recession could be coming. Financial experts debate whether this is the beginning of another major crash. For a moment, he wonders if they might be right. Watching tens of thousands of dollars disappear on a screen isn't exactly comfortable. But then something strange happens. His automatic investment buys more shares. Because prices are lower, the next month, it buys even more. Without realizing it, every market drop is quietly giving him a discount. Michael can't buy 20% more house because prices fell. James can buy 20% more ownership in hundreds of companies with the exact same paycheck. That's one of the biggest differences between these investments. One becomes more expensive to maintain when things go wrong. The other becomes cheaper to buy. Neither feels good in the moment. But over decades, feelings rarely determine returns. Then something neither of them expected happens. Home prices start climbing. Fast. Michael's $250,000 rental is suddenly worth $285,000. Then $300,000. He hasn't done anything special. He didn't renovate the kitchen. He didn't build an extra bedroom. The market simply moved. And because he only invested $50,000 of his own money, every increase in the home's value feels amplified. A 20% increase in the property's price doesn't mean he made 20%. It means his original investment has grown dramatically because he used leverage. That's the superpower of real estate. You control a large asset with a relatively small amount of your own cash. When prices rise, leverage feels brilliant. When prices fall, the exact same leverage becomes terrifying, because losses get amplified too. James doesn't have leverage. If the market drops 20%, his investment drops 20%. Painful? Absolutely. But nobody can force him to sell. Nobody can foreclose on an index fund because the market had a bad year. And that difference will become incredibly important before this story is over. The next few years change everything. Michael starts to notice something interesting. Every mortgage payment is doing two jobs at once. Part of it covers interest. The other part quietly reduces the loan balance. He doesn't feel it happening month to month. In fact, most of the payment still goes toward interest in the early years. But every single month, he owns a little more of the property than he did the month before. Without lifting a finger, his equity keeps growing. That's a form of wealth many first-time investors completely overlook. Cash flow gets all the attention. Equity is where much of the real wealth quietly accumulates. James has no mortgage to pay down, no tenant paying off debt for him. At least that's how it seems, because every month his automatic investment purchases a few more shares. Those shares begin earning dividends. Those dividends are automatically reinvested. And those new shares start earning dividends of their own. It's so boring that most people stop paying attention, which is exactly why compound interest is often called the eighth wonder of the world. It doesn't look impressive in year 3. It barely gets noticed in year 5. But somewhere around year 10, it begins moving like a snowball rolling downhill. By now, Michael has become a better landlord. He knows reliable contractors. He has learned to screen tenants carefully. He keeps money aside for unexpected repairs instead of hoping nothing breaks. Because eventually, everything breaks. A water heater, a fence, an appliance, a driveway, a roof. Real estate rewards preparation. It punishes optimism. Every experienced landlord knows this. The property isn't asking if something will fail. It's only deciding when. James has his own challenges. Every few months, the financial news predicts another market collapse. One expert says stocks are overvalued. Another says a recession is guaranteed. Someone else insists cash is king. The temptation to stop investing becomes stronger every year. Because doing nothing sounds intelligent when everyone around you is panicking. But history has taught long-term investors something most beginners never fully understand. The biggest returns often arrive immediately after the moments that feel the scariest. If you miss those days, you don't just miss a small gain. You can permanently reduce your long-term returns. 10 years have now passed. Michael's rental property has appreciated nicely. His mortgage balance is lower than when he started. His rent has increased several times. That extra cash flow feels much healthier than it did during the first few years. Looking back, those early repairs don't seem nearly as painful anymore. Time has softened them. James opens his investment account. For the first time, the balance surprises even him. His portfolio is now growing by amounts that once took him months to save from work. Some years the market adds more money than his annual contributions. Not because he became a better investor, not because he picked winning stocks, simply because time finally allowed compounding to do what it does best. And this is where most comparisons between real estate and stocks become misleading. People compare today's portfolio to today's property value, but they forget something much more important. Neither investment became valuable overnight. Both were rewarded by one thing: time. And the next 10 years will determine which strategy creates the larger net worth. By year 15, the gap between them isn't as obvious as most people expected. Michael's rental property is now worth considerably more than the day he bought it. His tenant has spent years helping pay down the mortgage. Rents have gradually increased with inflation. What started as roughly $300 in monthly cash flow has become something much more meaningful. On paper, it looks like real estate is running away with the race. But paper has a funny way of hiding expenses. Over the last 15 years, Michael has replaced a roof, installed a new furnace, repainted the exterior, paid legal fees after one difficult tenant refused to leave, covered months where the property sat vacant, paid higher insurance premiums, higher property taxes, higher maintenance costs. None of these expenses happened every month. That's what makes them dangerous. They arrive without warning. And when they do, they erase months, sometimes years, of cash flow in a single check. James hasn't written a single check for a new roof. He hasn't answered a late-night phone call. He hasn't worried about plumbing leaks. His biggest responsibility has been resisting the urge to interfere. Every market correction tempted him to sell. Every bull market tempted him to chase riskier investments. His greatest advantage wasn't intelligence. It was consistency. He simply refused to interrupt compounding. This is where leverage deserves another look. When Michael bought a $250,000 property with only $50,000 of his own money, he controlled an asset 5 times larger than his initial investment. That can create extraordinary wealth. If the property's value rises, most of the gain belongs to him, but leverage never disappears. If property values decline, or interest rates remain high, or rents stop keeping pace with expenses, leverage starts working against him just as powerfully. It's like driving a sports car on an open highway. It's exhilarating. On an icy road, the same speed becomes a liability. Leverage isn't good or bad, it simply magnifies whatever direction you're already moving. Meanwhile, James benefits from a different kind of leverage. Not borrowed money. Business leverage. Every company inside his index fund is constantly hiring employees, developing products, expanding into new markets, and finding ways to increase profits. He doesn't have to manage any of it. Thousands of executives are working every day, trying to increase the value of the businesses he already owns. He never receives a phone call asking him to approve a repair. He never negotiates with tenants. His investment keeps working, whether he's asleep, on vacation, or sitting at work. By now, friends begin asking both men the same question. So, which investment is actually better? Neither gives the same answer, because both are looking at different scoreboards. Michael sees growing equity. James sees accelerating compounding. They're both right, and they're both missing something, because the final 5 years completely changed the conversation. 20 years later, Michael and James meet for coffee. It's the first time they've actually compared the numbers, not the stories, not the opinions, the numbers. Michael's rental property is now worth roughly $450,000. His mortgage balance has fallen dramatically after 20 years of payments. His equity has grown through a combination of appreciation and principal repayment. His monthly rent has increased over the years, and after covering the mortgage, taxes, insurance, maintenance, and setting money aside for future repairs. The property is producing a healthy stream of cash flow. It's an asset that sends him money every single month. And that's a wonderful feeling. James opens his investment account. After 20 years of leaving his money alone, investing another $320 every month, reinvesting every dividend, and allowing compound growth to work uninterrupted. His portfolio has grown into an amount that once seemed impossible. No tenants, no repairs, no weekends spent meeting contractors, no emergency phone calls. Just thousands of small investments made consistently over 2 decades. So, who won? If you only compare net worth, the answer depends on the assumptions. A few percentage points of home appreciation, a slightly different mortgage rate, higher maintenance costs, or stronger stock market returns can completely change the outcome. That's why debates between real estate and stocks never end. Everyone is using different numbers, different cities, different time periods, different experiences. But there is one comparison that almost never changes. Michael had to manage his investment. James mostly had to ignore his. One investment demanded time. The other demanded patience. And those aren't the same thing. Time is something you spend. Patience is something you practice. That's why the real question was never, which investment makes more money? The better question is, what kind of life do you want while building wealth? Do you enjoy improving properties, negotiating deals, finding opportunities that other people overlook? Real estate can be an incredible wealth-building tool. Or would you rather spend your evenings with your family, travel without worrying about a tenant calling, and let hundreds of businesses work on your behalf? Then an index fund might fit you better. The biggest mistake people make is believing they have to choose one side forever. Many of the wealthiest investors own both. Real estate creates leverage, cash flow, and tangible assets. Stocks provide diversification, liquidity, and effortless compounding. Together, they balance each other's weaknesses surprisingly well. So maybe Michael and James weren't competing after all. Maybe they were solving the same problem, using different tools. Because wealth isn't built by finding the perfect investment. It's built by consistently owning assets that grow faster than your expenses, year after year, decade after decade. And whether that's a rental property, an index fund, or a combination of both. The most important investment decision isn't the one you make today, it's the one you keep making, long after the excitement wears off. Because in investing, the biggest returns rarely belong to the smartest person in the room. They usually belong to the one who stayed in the game the longest. Before you decide, there's one last thing you need to understand. Because this entire comparison has a hidden flaw. It assumes both Michael and James behave perfectly for 20 years. Real life doesn't work like that. Some landlords buy properties they can't afford. Some investors panic and sell the moment the market falls. Some refinance their homes to buy even more rentals. Others stop investing every time the headlines become scary. The investment itself isn't usually what determines the outcome. The person does. A great rental property can become a terrible investment if you overpay for it. A simple index fund can become a terrible investment if you keep buying high and selling low. Success has far less to do with the asset and far more to do with your behavior. That's the part social media rarely talks about. Because discipline isn't flashy, consistency doesn't go viral, patience doesn't make exciting thumbnails. But those 3 things quietly create millionaires every single year. Think about it. Michael didn't become wealthier because he owned a house. He became wealthier because he kept the house. He survived vacancies, repairs, higher interest rates, unexpected expenses. Most people quit somewhere along that journey. He didn't. James didn't become wealthier because he found a secret stock. He became wealthier because he kept buying. During crashes, during recessions, during years when everyone around him claimed the market was finished. He kept investing anyway. Most people stop. He didn't. That's the lesson hiding underneath this entire story. Real estate isn't magic. Stocks aren't magic. Compounding is. Consistency is. Time is. The longer you own productive assets, the harder they begin working for you. Eventually, your investments start earning more than your paycheck. Then, your wealth begins growing faster than your effort. That's the moment financial freedom stops being a dream and starts becoming mathematics. So if someone asks you, should I invest in real estate or stocks? Don't answer too quickly. Ask them a different question. Which investment can you stick with for the next 20 years without giving up? Because the best investment isn't the one with the highest return on paper. It's the one you'll still own when everyone else has already quit. If you can master that, you'll already be ahead of most investors. If you enjoy clear, data-driven videos about investing and building long-term wealth, subscribe and turn on notifications. We're just getting started. Thanks for watching, and I'll see you in the next one.